Welcome back to the Pro Ticker Podcast, your Wednesday morning edition covering major financial magazine headlines, everyone. And welcome to the deep dive. We're here to cut through that noise from sources like Reuters, CNBC, MarketWatch, Bloomberg, and Yahoo Finance. We're focusing specifically on news hitting around June 3rd and 4th.
Yep, and our mission really is to pull out the most important nuggets, those surprising facts, from this big pile of news just for you.
We've got a lot on the docket. Corporate earnings, stock moves, big investment plans.
Supply chain hiccups, and, the usual dose of geopolitics and political commentary stirring the pot in the economy and markets.
It really shows how everything's connected, doesn't it?
It absolutely does. So where should we start?
Let's kick off with a snapshot of the global markets. How is the general tone looking this week?
Well, according to CNBC Daily Open, U.S. stocks actually had a decent climb on Tuesday, June 3rd.
Right, I saw that. Boosted by chip stocks, wasn't it? And those job openings numbers for April came in higher than expected.
Exactly. The numbers themselves. Let's see, S&P 500 gained 0.58%, Dow Jones up 0.51%, and the NASDAQ led the charge up 0.81% on Tuesday. Solid day.
But, and here's the twist, sources like Yahoo Finance and CNBC Daily Open pointed out that Wall Street seemed to, well, kind of shrug off the new tariff risks initially.
Yeah, futures were holding pretty steady Wednesday morning. Even as that tariff news was breaking, it created this kind of tension.
Tension is a good word for it. You see the games, but analysts are sounding cautious notes.
Right. Sam Stovall over at CFRA Research, he was quoted in the CNBC Daily Open, he said the market is just bobbing and weaving. Yeah,
Bobbing and weaving, implying these gains might not be built on solid ground.
pretty much. Suggesting it might not signal a longer-term rally, especially with these tariff questions hanging over the U.S. economy. Some headlines were even more blunt, calling it likely just short-term optimism and shaky.
And this wasn't just a U.S. thing, right? Asia-Pacific markets were also up on Wednesday, according to CNBC Daily Open.
That's right. South Korea's Kospi surged, what was it, 2.5%, hitting its highest level since last August after their presidential election. Big move.
And Australia, too, adding 0.77%, even though their Q1 growth missed expectations.
Yeah, so some positive signals there. Europe was quieter, though. The Stoxx 600 just nudged up like 0.09% on Tuesday, clawing back some earlier losses, again from that CNBC source.
So globally, it's a bit of a mixed bag. Some momentum, but definitely this undercurrent of worry, mostly tied back to trade stuff.
Precisely. Those trade tensions are casting a long shadow.
Okay, let's zoom in from the broad markets to some specific company highlights and stock movers. There were definitely some big stories.
Oh, yeah, and you pretty much have to start with NVIDIA, right?
Absolutely. CNBC Daily Open, MarketWatch, they both covered NVIDIA's Big Tuesday, up 2.8%.
Yep, closing at $141.22. And that pushed its market cap back above Microsoft's. We're talking $3.45 trillion for NVIDIA versus $3.44 trillion for Microsoft.
Wow, so NVIDIA is back on top as the most valuable public company. MarketWatch noted it's the first time since, late March?
That's right. And Apple's kind of hovering just under $3 trillion now. So the big tech rankings are definitely shuffling.
But why NVIDIA? What's driving this continued surge?
Well, MarketWatch was pretty clear. It's that relentless, seemingly unstoppable demand for AI chips.
Yeah.
No signs of slowing down.
And analysts are bullish. Jefferies added it to their high-conviction buy list.
They did, calling NVIDIA, and I quote, the dominant supplier of AI accelerators for data centers. I mean, that says it all.
It's not just current sales, though. MarketWatch mentioned the ramp-up of their new Blackwell AI platform. That's expected to boost margins.
Big time. Gross margins expected to reach the mid-70% range by year-end. That's up from 61% adjusted in Q1. That's a huge jump in profitability potential.
And the scale of this AI demand. MarketWatch had this interesting detail about NVIDIA's sovereign AI business, countries buying chips directly.
Yeah, think Saudi Arabia, the UAE, committing serious investment to build their own national AI infrastructure using NVIDIA tech. There was even a specific partnership mentioned with a Saudi firm, Humane, to deploy 18,000 chips over 5 years.
18,000 chips. Just one deal. Gives you a sense of the scale.
It really does. Governments are becoming major players in this space.
Now, speaking of companies riding the AI wave, Hewlett-Packard Enterprise, HPE, also had some positive news.
Right. MarketWatch and CNBC's after-hours coverage pointed to a strengthening AI pipeline for them. Their stock popped after beating Q2 earnings and revenue estimates.
What were the numbers?
CNBC after hours had adjusted earnings at 38 cents versus 33 cents expected, and revenue was $7.63 billion. beating the $7.45 billion estimate. So solid beats.
And MarketWatch added some color on the orders.
Yeah, they booked $1.1 billion in net new orders in Q2, about a third from enterprise customers, and apparently they have very large deals in the pipeline. Their specific AI backlog is sitting at $3.2 billion, with the overall pipeline being multiples of that.
So serious demand there, too. It sounds like their expertise in direct liquid cooling is a key advantage for these power-hungry AI chips.
That's what MarketWatch suggested. It's necessary tech for things like NVIDIA's GB200s, and HPE is apparently already deploying those in large scale.
So they're right in the thick of building out this infrastructure.
Definitely. Though, just a quick aside, MarketWatch did flag that upcoming trial date, July 9th, for HPE's fight with the DOJ over the Juniper Networks deal. So, not entirely smooth sailing on all fronts.
Got it. Okay, shifting to financials, big news for Wells Fargo.
Huge news. MarketWatch and CNBC After Hours both jumped on this. The Fed lifted the bank's asset cap on Tuesday.
And that cap has been hanging over them since the fake account scandal back in 2018, right?
Right.
Really restricted their growth.
Exactly. MarketWatch called it a milestone. The CEO did too. One analyst even called it Liberation Day.
Liberation Day. Wow. So what does this practically allow them to do now?
Well, according to MarketWatch, it finally lets them grow again. Expand things like corporate deposits, investment banking, retail banking, credit cards, wealth management areas where they've been seriously held back for years.
So potentially a big turning point for them. Their stock rose after hours, but MarketWatch pointed out they've lagged peers like JP Morgan and BofA since that cap was imposed.
Right. So the big question now is, can they actually use this freedom to catch up? Definitely one to watch.
Now, staying in tech, but on a different note, Salesforce. Their stock's been under pressure lately, even after a decent earnings report last week.
Yeah, it's interesting. Jim Cramer weighed in on this, according to a CNBC source. He reckons it boils down to a couple of key worries on Wall Street.
Okay, like what?
First, there's concern that their agentic AI arm, the AI that can supposedly act on its own, isn't growing fast enough. And second, there's skepticism about that big $8 billion acquisition of Informatica they just announced.
Ah, the Informatica deal. Why the skepticism there?
Well, Cramer suggested, based on that CNBC report, that analysts are kind of wary because Salesforce arguably overpaid for Slack back in 2021. Remember that $27 billion deal?
Right.
And the perceived benefits from Slack haven't been super obvious. So there's this fear of repeating that pattern, maybe overpaying again for Informatica without a clear payoff.
Makes sense. So what's Cramer's take overall on Salesforce?
He sees it as an earnings growth story. They are increasing profitability. But he stressed that agentic AI needs some bold-faced customer wins. It needs to prove it can actually let companies replace workers, essentially.
So it's a show-me story, as they say.
Exactly. Cramer said investors need faith in management right now. It's about execution.
Okay, let's jump over to Japan. A really surprising move with Toyota Industries stock. It slumped pretty badly on Wednesday.
Yeah, big time. Down almost 12% at the close, according to CNBC Daily Open and Yahoo Finance. And this was after news broke about a potential $33 billion deal for the parent company, Toyota Group, to take it private.
Wait, usually takeover news sends a stock up? What happened?
Disappointment over the price. Yahoo Finance explained that the tender offer price, $16,300 per share, was actually way lower than the previous day's closing price of $18,400.
Ouch. So shareholders were being asked to sell out at a discount.
Effectively, yeah. Investors were likely expecting a premium, not this. Yahoo Finance noted the parent company was partly doing this due to pressure to untangle complex corporate structures, but the lowball offer drew criticism for, quote, undermining minority shareholders.
A definite misstep there. And still in Japanese autos, Nissan's facing its own challenges.
It sounds like it. CNBC reported the CEO is laser-focused on fixing the struggling automaker.
They've got a tough road, right? Declining sales, the EV transition, fierce competition, especially from China.
And now, as that CNBC source highlighted, add President Trump's new 50% tariffs on steel and aluminum to the mix. That's a direct hit to their costs.
Plus, didn't they plans for big job cuts and plant closures recently? And talks with Honda fell through?
Yep, that CNBC report mentioned those past plans and the Honda talks breaking down. So, yeah, definitely facing some serious headwinds over at Nissan.
And those headwinds, like the tariffs, bring us right into the next big theme. These broader geopolitical and economic forces really making waves.
Absolutely. Trade tensions are definitely ramping up again. We saw reports on this from CNBC Daily Open, Yahoo Finance, Bloomberg. It's a major focus.
The big headline grabber was President Trump doubling those steel and aluminum tariffs, right? From 25% to 50%.
Effective Wednesday, June 4th. Yeah, that's a significant hike.
Yeah.
Yahoo Finance and CNBC sources detail that.
But the UK got a temporary reprieve. CNBC mentioned that.
They did, for now. They stay at 25% while a trade deal is supposedly worked out.
Yeah.
But they could still get hit with the 50% rate later if the U.S. isn't satisfied with their compliance on the deal by, I think it was July 9th.
So uncertainty even for them. Who gets hit hardest by the 50% rate immediately?
European steel exporters, mainly. Think Germany, Italy, Sweden, the Netherlands. CNBC flagged them. The UK industry, even with the 25% rate, called it punitive and said 50% would be prohibitive. So major concerns across the board.
And is UF just going to take this?
Doesn't sound like it. The CNBC tariff source explicitly said the EU is prepared to impose countermeasures if they can't reach a solution. So, the risk of this escalating into a tit-for-tat situation is very real.
What's the expected economic impact?
Well, analysts told CNBC they expect U.S. domestic steel prices to jump significantly. That flows through to automakers, construction, even things like canned goods for consumers. European prices might be more mixed, maybe some downward pressure if supply gets redirected there.
And it's not just steel prices, tariff uncertainty, inflation. It's affecting consumer behavior more broadly, too.
Yeah, Yahoo Finance source pointed this out specifically in the snacking category. Think Campbell's, PepsiCo, Kraft Heinz. Consumers are apparently cutting back on impulse buys, looking for deals, trading down, causing volume declines for those big companies.
Interesting ripple effect. Beyond tariffs, there was also noise about the U.S. and China trading barbs over their existing trade deal.
Right. CNBC Daily Open reported on that. Accusations flying back and forth about violations.
And President Trump commented on dealing with President Xi.
He did. Bloomberg and CNBC sources quoted him saying Xi is extremely hard to make a deal with. This came even though White House officials had previously hinted a call between them was likely.
Meanwhile, China's foreign minister called for the U.S. to meet China halfway. So still pretty far apart.
Seems so. And those sources highlighted specific friction points. China apparently hasn't eased rare earths export curbs like expected. The U.S. keeps limiting China's tech access, the visa revocations for Chinese students.
Yeah.
Lots of ongoing tension.
And speaking of those rare earth curbs, they're having real-world consequences now.
Very real. Reuters reported that several European auto supplier plants have actually had to shut down production lines because they can't get the rare earths they need from China.
Wow. So it's gone from a trade dispute to actually halting manufacturing in Europe?
Exactly. The Auto Suppliers Association, CLEPA, told Reuters that only about a quarter of the export license requests they've made since April have even been granted. And some were rejected on seemingly minor procedural grounds, with rules varying by Chinese province, plus requests for sensitive IP info. That sounds messy.
It does. And Reuters included a warning from CLEPA. If this process isn't smoothed out fast, we could see more plant outages in the next 3 to 4 weeks as their current inventories just run out.
A stark example of supply chain vulnerability.
Okay, so let's shift gears slightly and look at the broader economic picture and what central banks are doing, particularly in Europe.
Right. We got some updated forecasts from the OECD that weren't exactly cheerful.
No, not really. CNBC Daily Open and Bloomberg reported they slashed the U.S. growth forecast for 2025 pretty significantly down to 1.6% from 2.2%.
And the global forecast trimmed too.
Yep, for this year, down to 2.9% from 3.1%, according to CNBC Daily Open. And importantly, they pointed directly at substantial increases in barriers to trade, those tariffs we were just discussing, as a key reason for the gloomier outlook, along with tighter financial conditions, weaker confidence, the usual suspects.
So trade wars are actively dragging down global growth estimates.
That's the takeaway. Now, meanwhile, over in Europe, the European Central Bank, the ECB, looks set to make a move.
A rate cut. Almost guaranteed, according to a CNBC source covering the ECB. They're expected to cut by 25 basis points on Thursday. Markets were pricing it at like 99% probability.
And that's possible because inflation has come down in the Eurozone.
Exactly. Headline inflation fell to 1.9% in May, just under their 2% target. Core inflation eased too. So on paper, they have the room to cut. That came from CNBC Daily Open and the ECB source.
But the outlook beyond this week is fuzzy?
Very fuzzy, yeah. That CNBC source stressed the high degree of uncertainty facing Europe's economy.
Factors like?
Well, the U.S. tariff situation, potential EU retaliation, new defense spending plans in Europe, Germany's whole fiscal debate. It all makes predicting the path forward pretty tricky for the ECB.
So what are analysts thinking about future cuts after this one?
Views are split, according to that CNBC source. Some see another cut maybe as soon as July. Others, like analysts at Barclays, think they might pause over the summer and then maybe cut again in September and December.
And BOFA suggested they could go below 2% eventually, but probably won't signal it yet.
Right, using the tariff uncertainty kind of as cover to keep their options open without committing too much right now.
And for consumers in Europe, what does this mean?
Generally, more cuts would mean lower borrowing rates, think mortgages, loans, but also lower returns on savings accounts. The exact impact, as CNBC noted, really depends on the specific products, like fixed versus variable rates.
Okay, let's pivot to our final section, this really interesting overlap we saw in the news between politics, tech, and finance. Lots happening there.
Yeah, definitely grabbed headlines. And a lot of it involves Elon Musk and his recent interactions with the Trump administration.
Right, he just finished that temporary stint leading the Department of Government Efficiency, the DOGE initiative, aimed at cutting federal spending. Bloomberg and CNBC covered that.
He did. And right on cue, Senator Elizabeth Warren's office released a report which a CNBC source detailed pretty thoroughly.
What did the report allege?
It chronicled Musk's, quote, 130 days at DOGE and accused him, again, this is the report's claim, of using that government role to benefit himself and his businesses over 100 times.
100 times. What kind of examples did they give?
Well, the CNBC source citing the report mentioned things like allegedly using the government platform to promote his businesses. They cited a Tesla showroom, apparently set up on the White House lawn.
Okay.
Also claims that the administration or agencies explored or entered into lucrative contracts with Musk's companies, like Customs and Border Protection, looking into using Starlink.
Anything else?
The report, according to CNBC, also alleged that agencies might have halted enforcement actions against his companies, or that DOGE itself targeted agencies that were investigating his companies. They mentioned an OSHA investigation into Tesla being closed. Again, these are the specific allegations from the report, as covered by CNBC.
Understood. Reporting the report's claims. Any reaction to this?
Well, that CNBC source also noted 3 Democratic senators are now pushing for a DOJ investigation into potential conflict of interest violations by DOGE employees who might own stock in companies that could have benefited. So it's causing waves.
Okay, shifting slightly, but still with Musk, he also had some strong words about President Trump's proposed tax bill.
He did. Bloomberg and CNBC Daily Open reported he went on X, formerly Twitter, and called Trump's big, beautiful bill a, quote, disgusting abomination. Strong language.
Why? What was his reasoning?
He claimed it would blow up the budget deficit, adding like $2.5 trillion. According to Bloomberg, Musk argued this would completely wipe out any savings his DOGE team had supposedly achieved.
How did that go down politically?
Mixed reactions, as Bloomberg reported. The White House press secretary kind of brushed off his criticism. Senator Mike Lee seemed to agree with Musk. House Speaker Mike Johnson called Musk's comments very disappointing. So, dividing opinions.
What do the sources say about the bill itself, the deficit impact?
Bloomberg cited forecasts suggesting it would lower federal revenue by about $4 trillion over 10 years, adding around $2.5 trillion to the deficit, even factoring in some planned cuts to safety net programs.
And wasn't there a part of the bill that Tesla itself objected to?
Yes, exactly. Bloomberg mentioned the bill aims to aggressively phase out the Biden-era tax breaks for electric vehicles and clean energy production. Tesla Energy argued this would, quote, threaten America's energy independence and the reliability of our grid. So direct opposition there from his own company.
Meanwhile, Trump is still pushing for the bill.
Oh, yeah. Bloomberg reported he's pressuring lawmakers, even criticizing Senator Rand Paul, who opposes the bill's debt ceiling increase, calling him crazy. Paul's argument is simply that it adds too much to the national debt.
And the debt ceiling deadline is looming, right?
August or September is when the Treasury expects the U.S. to run out of borrowing room, according to Bloomberg. So that's part of the pressure. Trump was also planning to meet with Senate Finance Republicans on Wednesday to rally support.
And the White House claims the bill pays for itself through growth.
That's their argument, yeah. Though Bloomberg noted most outside economists don't really buy that.
Okay, another big political financial intersection. President Trump and the crypto world.
Yes, definitely seeing more moves there. Yahoo Finance and CNBC sources picked up on this.
Yahoo Finance talked about this trend of companies copying Michael Saylor's strategy, MSTR.
Exactly. The playbook is basically borrow money or issue stock, use the cash to buy huge amounts of Bitcoin for the company's balance sheet, hoping your stock price follows MSTR's incredible run.
And MSTR has done incredibly well with that strategy.
Phenomenally. Yahoo Finance noted they hold over 580,000 Bitcoins, worth like $40.6 billion at the time of the report, And their stock is up something like 2,900% since 2020. So you can see why others are tempted.
And it's not just crypto companies doing this.
No, Yahoo Finance said dozens of public companies are trying it, including at least 36 that aren't originally from the crypto sector.
And Trump's own company, Trump Media and Technology Group, DJT, is jumping on this bandwagon.
Big time. Yahoo Finance detailed their plans, announced just last week, to raise $2.5 billion specifically to build one of the largest Bitcoin treasuries of any public company, part of a bigger digital asset strategy.
The CEO called Bitcoin an apex instrument of financial freedom.
That was Devin Nunes, quoted by Yahoo Finance. And related to this, CNBC reported that Trump's Truth Social platform is taking steps towards launching its own spot Gitcoin ETF.
An ETF? Really?
Yep. NYSE ARCA filed the paperwork to list a spot Bitcoin ETF linked to Truth Social. This follows a partnership Trump Media made with Crypto.com to launch various branded digital asset products globally, including ETFs.
And the market for these spot Bitcoin ETFs is already huge, right?
Massive. Over $130 billion in assets since they launched in January, according to CNBC, with BlackRock's fund leading the pack. So Trump Media is trying to tap into that existing demand.
But this strategy isn't without risks, surely.
Definitely not. Yahoo Finance explicitly mentioned the volatility. If Bitcoin's price tanks, companies that borrowed heavily to buy it could face bankruptcy. It's a high-stakes bet, especially with leverage, in what they called a potential number-go-down market.
And are there other major players imitating Saylor besides Trump Media?
Oh, yeah. Yahoo Finance named a couple. 21 Capital, which is backed by SoftBank, Tether, and Cantor Fitzgerald, already raised $685 million. And another called Nakamoto Holdings, run by a Trump crypto advisor, apparently plans to acquire 25 public companies within a year and turn them into Saylor clones, raising $710 million. So it's becoming a real phenomenon.
Wow. Okay, just a couple more quick political legal items. The Justice Department dropped its lawsuit against Peter Navarro.
They did, according to MarketWatch. This was the civil lawsuit accusing him of using unofficial email for government work and keeping presidential records from the first Trump term.
And this comes after he already served prison time for the related criminal charges.
Exactly. He did 4 months for refusing to cooperate with the January 6th investigation. MarketWatch noted the DOJ didn't actually state why they were dropping this separate 2022 civil suit now.
Interesting timing. And finally, Fed Chair Jerome Powell gave some advice recently.
Yeah, he spoke to Princeton graduates, reported by CNBC. He urged them to guard their integrity.
Which sounds pointed, given President Trump's criticism of him.
That was certainly the interpretation. CNBC provided the context. Trump has been hammering Powell for months to cut interest rates, calling him names like a major loser, threatening to fire him, all presumably to boost the economy.
But Powell's position remains that the Fed ignores politics.
That's what he insists. He says the FOMC only looks at economic data, the outlook, and risks. And CNBC noted he's actually kept rates steady, partly because of potential negative side effects from Trump's own tariff policies.
So quite the pushback there. Did he say anything else?
According to CNBC, he also really emphasized the value of public service, using the Fed's own actions during the pandemic recession risk as an example of vital work done by career civil servants, and encouraged the grads to consider that path.
Wow. Okay. That really was a deep dive. It's incredible how much interconnection you see just looking at a couple of days' worth of headlines.
It really is something, isn't it? You've got markets trying to balance optimism with serious trade worries. You have huge corporate bets being placed on AI and crypto.
And then you see these direct lines from political decisions like tariffs or regulations straight through to supply chains getting disrupted or companies changing strategy. It's all linked.
Totally. Those rare earth restrictions we talked about, a decision in China halts auto production lines in Europe, or just presidential commentary on a tax bill sparking wide debate and maybe even factoring into central bank thinking.
And things are moving so fast. NVIDIA's climb, that rapid imitation of the Bitcoin treasury strategy, how quickly those tariffs were implemented.
The pace of change is definitely accelerating.
It really leaves you wondering, with all these different pressures hitting various sectors and seeing how policy impacts can be so unpredictable, what's the next overlooked sector or market signal that might suddenly show a surprising sensitivity to all these global forces?
That's a great question. Definitely something for all of us to keep mulling over.
Indeed. And with that, we'll see you all tomorrow morning with new headlines from major financial magazines.